Good morning, ladies and gentlemen, and welcome to the first panel session of this year's MGAA conference. My name is Michael Mendelowitz. I'm the Head of Legal and Compliance at the UK branch of ERGO Versicherungsaktiengesellschaft, and it is my pleasure and honour to welcome you all here on behalf of ERGO as one of the sponsors of this event, particularly to see so many of you here today. I think this must be a record turnout. We have a very distinguished panel to debate the issue of evolution of an MGA, survival of the fittest. If I may introduce them, from left to right, we have Jason Anthony, who's the founder of MGAM Limited, Karen Beales, the managing director of UK General, David Howden, the CEO of Hyperion, and Olly Laughton-Scott, who is a partner of IMAS. Just a couple of housekeeping announcements. Please do the usual, turn off your mobile phones or switch them to silent for the next hour and a half. And without further ado, let me use the chairman's prerogative to personalize my introduction. The phase of my career, which I am at the moment, started almost exactly 30 years ago when I came in. I joined a city law firm as a senior associate doing insurance and reinsurance dispute resolution. And in 1987, MGA was perhaps not a dirty word, but certainly it was controversial. I spent the first 10 years of the present phase of my career very happily and very lucratively litigating for and against MGAs, their clients, trying to retrieve unpaid claims, raising issues of misrepresentation and non-disclosure. And it seems to me that at that time there was no distinction, as there is today, between what Roger Bickmore referred to in his introduction this morning as abrogated underwriting authority rather than delegated underwriting authority. It seems to me that in those days the two pretty much went hand in hand. Fast forward 30 years, and you will read, those of you who get the online feeds from that wonderful journal, Intelligent Insurer. Is there any other kind? That was a rhetorical question. Please don't answer it. But they've been trailing an MGA special edition lately, and this morning it forms the headline, and the introduction says, despite a multitude of pressures in the wider reinsurance markets, MGAs have not only performed well in recent years, but their services are also increasingly in demand from capacity providers seeking diversification and new revenue streams, and the special report is all about it. We're going to kick off with a presentation from Olly, who's going to give us some facts and figures about the current state of the MGA market, and then I'll ask each of our panelists to give a short presentation, 5 minutes, no more, please, on their view of evolution of an MGA, survival of the fittest, and then we'll throw it open to questions from the panelists to each other and to members of the floor. So, Olly, thank you.
Right, so first of all, panelists you will definitely know, I'm Olly Laughton-Scott from IMAS. We are an M&A boutique which does work for financial services, and we do a very large amount in the insurance industry. So I'm glad to be speaking here. MGAs clearly add value, which I think we're going to demonstrate through this morning. And in creating value, they create capital value, and that's where our expertise comes in. I'm going to present some numbers showing that MGAs are an increasingly important feature of the market, and so it's no surprise today that it's so well attended. Right, this is a quick advert. So we do M&A in the insurance sector, and one thing that we produce that you may well have seen is the Insurance Times Top 50 on the brokers. So that's one of our publications, and we are at this very moment sweating through producing that. This is what I really want to show you. Now, you may not be able to see, but this line here starts at around 7,200 and goes down to about 3,200 there. And this is that's the number of total brokers, authorised brokers in the UK financial services market. And this is the number of MGAs, so starting at about 110, and this is January 05 when this was first regulated. So it starts at 110 and goes up to 190, and this is the number of wholesale brokers, so that's principal activity. So that's a picture of the market. So what that shows is that since 2005, the number of authorised brokers, it says actually here almost halved, actually deliberate error, has over halved. That's a dramatic change, which has implications clearly for the industry. And for those people, the younger people here, if you're about 25, anyone 25 here, by the time that you retire, the trend suggests there'll be only one broker left.
Thank you, Olly. I appreciate it.
That is bad news for you, but it's worse also for all the MGAs in this room. But I think it's quite an important point because the market is clearly going through a massive structural change. And I did talk at the Old Lawyers Library 3 months ago with lots of stats about that, so if you're interested in that, let me know and I'll send you those slides. But what it also shows is a very strong performance from MGAs. And that is for a reason. It's because they add value. And that's a major development over the market. If the MGAs before the rest of the market, they'd be down to 40. And we'll see it at 190. So that gives you real confidence that this market, that you are adding value to the market. If we then look at deals in the market, so what we've got here, we've got the blue, which is the whole broker market, and that goes from around 13 up to there, that is 30. So we're seeing over 5 years, the trend line sees the number of broker deals doubling. And if we look at the MGAs, which is the orange, we're seeing that as almost flat, with a slight increase over those 5 years. But clearly what's happening for the broker market is quite a difference to what's happening for the MGA market. And maybe we can discuss that during the course of the presentation. But it's not necessary. It's partly because brokers have been very successful, MGAs have been very successful, and they still have a revenue debt, and therefore they're growing, and therefore people aren't thinking, oh, well, the game's over, I'm going to sell. They are being successful, they're growing, and they're adding value. And I should say that both these last two charts came straight from our website. So we haven't sort of picked figures to flatter. We've gone onto our website, there's a lot of ads on our website, and we picked out these charts. So this is absolutely numbers as they come out fresh. And then this is, so what we are now looking at here is the ownership structure of brokers versus MGAs. And what we see, not surprisingly, is the great majority of brokers, the great majority of MGAs are still privately held. But the real difference is around private equity. We've seen actually that the private equity, PE, has invested quite heavily in MGAs. They've also clearly invested in brokers such as PIB, but the number, so from private equity in brokers, it's less than 10%, and MGAs is about 20%. Now what is interesting about that is actually we think the investment thesis is quite different. The investment thesis for the broker backing is all about consolidation. So we're seeing examples of that being particularly PIB, for example. Then for the private equity investment in MGAs, so the recent one was CFC bringing private equity, that's much more about the organic growth play. And with the right capital structure, you can then attract people to join your business, you can incentivize them with shares going forward, but it's much more organic play. So there are two quite different plays going on in the broker market and in the MGA market. And so finally, are MGAs just another mouth to feed? That's a comment which is quite often made. You can't really talk about the role of MGAs without talking about the role of insurers. And that's in the context of, I believe, long-term oversupply of capacity. I think that when 20 years ago, 30 years ago, people were doing their exams, there was a thing called the insurance cycle. And they did that. And we also thought the insurance cycle was hard market, soft market. I fundamentally believe now that the capital market is so flexible that we are in a long-term soft market and that will never change. But I think that the interesting thing about the insurers and the MGAs is that we are seeing, in reality, the insurers under intense pressure as large organisations not performing very effectively. And actually we see their roles being carved out and becoming just the providers of capital and allocating capital and allocating risk at a high level, while we see other organisations doing more of the stuff of the insurance industry and MGAs are very much part of that process. So why not that be the case? Well, clearly I say the numbers show that the business, the sector, the MGAs are performing very effectively. Our MGAs just underwrite all distributors, and I think that actually comes down to the common feature is they're all around being able to move and create value and support opportunities. I think that both on the underwriting and on the distribution side. Now, if you look at regulation for insurers, this encourages scale and diversification. But this means that they become, for regulators, big is beautiful. They're actually big organisations with very large capital bases and with lots of people employed. But this provides the MGA the ability to provide focus. And insurers find that increasingly difficult to do so. So what we're seeing is insurers getting ever larger, ever more complex, and we're seeing MGAs providing that focus and flexibility. And so the scale makes them agile. I mean, it's very hard as a large organisation to take decisions. And only when you deal with large organisations do you realise that we were selling one business to a very large broker, and it took them 6 months for it to get through the board, because it was never large enough in the States for them to really focus on it, and they had another issue. They were trying to buy Target at the time, and that got in the way. So for very large organisations, they find their decisions very difficult, and the scale of the MGA makes them agile. And what's important is that in this world, agility is getting ever more important. The rate of change, the rate of opportunities that technology, that data, that information, just going onto the internet creates. I was talking to an old friend, and he was saying that his son, aged 25, has now got a dual career, working for himself and working for a large organisation. That would never have happened 20 years ago. I can't imagine that when I was 25 years old. And he said, it's the internet. So there's enormous change going on, and large organisations find that very hard to cope with. Now, what of course then you have this whole life cycle. MGAs get larger, and then they get, then they think, how do we exit? And of course, one of the people that actually comes along and buys them is the insurer. But there are a couple of points I'd like to make now. First of all, that large insurers find it very hard to cope with small organisations. So quite a lot of people come talk to us about making an exit, and they say, oh, we sell to an insurance company. But actually that's quite complex, because the insurance company just doesn't have the mechanism, the management and structure to actually run that business. So they're not a natural buyer for that business. And I think the other issue is that the operational fit often isn't there, because that's why the MGA has been successful, because it's actually done a number of different risks and used different insurers. So it's not clear that insurers are the natural fit. They may often be the buyers because they have a low cost of capital. But I still believe that in the long term, we're going to see the insurers buy these businesses, and then they actually struggle because what the MGA had was flexibility, and when we bought by an insurer, they tend to lose that. So it's a very complex process, the creation of value, and actually realising that. And I think the MGAs need to be aware that there isn't necessarily a simple solution out there for that problem. Thank you very much.
So I'm now going to turn, if I may, to David, and ask you to give your take for a few minutes on today's topic, evolution of MGA, survival of the fittest.
Okay, all right, thank you, yeah. So I think that was a good intro by Olly. I think just to give you a bit of background, I'm CEO of Hyperion, and I set the group up 23 years ago now with 3 people, and some of you may know a dog, because the dog came to the office because my first wife left me. So I have a small company culture. I know what it is to actually build a business, but I know what to build a business that hasn't been sold in nearly a quarter of a century as well. And I think that's something to think about, because I think a lot of MGAs, why you're building your MGA or where you wanted to go to is quite important. Are you building it to sell it? I think Olly made a good point about is a good home an insurer. Some of you building MGAs have probably escaped insurers. Why would you want to flog it back to an insurer? I never get that, and I think the insurers pretty quickly destroy the value in the MGAs that they built in the first place. So, my context here is someone who's built a business, building a business still, but also the context that we have 3 very separate businesses within our business. We're not a big business. And in fact, within those 3 businesses, we have hundreds of businesses. So I run Hyperion, which has RK, which is a specialty broker, has Howden as a retail broker, and Jewel as our MGA arm. And even within Jewel, we operate out of 12, 13 countries. We have about 40 companies. They very much operate with a small company culture, because that dynamism, that agility you need is exactly right. So we're trying to work out how we do it. I started my first MGA in 1997. It wasn't in the UK, it was in Spain. I had a wholesale broker, Howden, was doing Spanish business in Spain. Pat Ryan bought my biggest producer, was Gilly Carbajal. I thought, sugar, how am I going to carry on getting my capacity? It's quite important, this distribution. How am I going to carry on getting my capacity into a broker who competes with Howden? And the answer was to create an MGA. So we took the line slip, it was an old-fashioned Lloyd's line slip, we turned to the MGA, we rebranded Jewel, and we created Jewel. And today, Jewel is one of the most successful MGAs in Spain, and it still writes a shed load of business to Aon. So it was a very successful thing. So that was all about actually market challenges. And I think Olly's right, is that to me, one of the reasons there's a rise in the MGAs is much more to do with overall insurance market fundamentals than just whether MGAs offer value or not. I clearly like them, and I believe they do, but I think what they're reacting to is where we are in the market. I don't think it's about just soft market. I don't think, if you look at it today, very roughly, and I'll talk from a more international scale, 10% of the UK market is written by MGAs and 10% of the US market. They write about 40 billion in the US, and they write, whatever it is, 5 billion here. So there's roughly 10% of the market on both markets. And I think that's here to stay. And if you look at something like Australia, which is another quite big MGA market, you see someone like Steadfast, who was really an aggregator. They floated with the thought, as Olly said, to actually aggregate brokers. What do they really spend all their money on? They spend all their money on buying MGAs. And you've just seen today, actually, funnily enough, Chaucer come back as an insurer to buy. And to me, this is about 3Ds. My 3D vision for the market is really about three things. It's about distribution. If you can't get your product out there, forget it. Because, we all get very hung up whether we're an insurer or whether we're a broker or whether an MGA. I gave a talk to my daughter's school. She's 18 years old, on why insurance is anything but boring. And I think I got that message across, but I can tell you, they didn't know or care, whether they don't understand. They want a good product, a good service in a different way. And I think we need to think about that. It's all about how do we deliver value to the ultimate clients. So that whole distribution point is absolutely clear. And what you're seeing in that is a delineation. So all those old things are getting merged a bit. And I only touched upon it. What is the value of an insurance company balance sheet if capital is that cheap? How can an insurer charge for actually the insurance services if it's outsourcing that service to the MGA? How can the PRA regulate the insurer and one cost is there, and then the FCA regulate the MGA and another cost is there? That's all, we've got to work that out together, because that cost is all going down to the ultimate client. And coming into the new space are people who've worked that out. There's people that work that out, that our margins, can range. Good MGA margins can be, it's probably public, I think what CFC's margin was, can be high. Let's just put it that way. That's great news. But what a high margin business is absolutely perfect for? Disruption. And you look at the new tech ones coming on, and there's a session on tech later on. Technology is looking at this and thinking, how can we deliver lower cost? And actually that isn't for us as MGA owners to do, or insurers, it's the whole market to think about. And if we don't focus on it and recognize it, it'll happen. And Olly's other point, one broker left in the world. I don't think that's true, but I think we are seeing massive consolidation. It's not just in broking or in insurance. You're seeing across the board. Look at Amazon. Will there just be one retail company in the world? What does that mean to MGAs? Initially, yes, it means the insurers want cheap, and I think that's relevant to them, cheap and quick access to distribution, because they want to actually shore up their balance sheets with good premium. But longer term, if the number of suppliers to the MGA shrinks to 1 or 10 or 20, however it may be, what happens to your market then? Because I can tell you most brokers who, are looking to consolidate their panels. I'm not just talking about with MGAs, insurers as well. You're seeing that right across. What's the biggest rise going on in the market today, particularly in the London market? It's actually what Aon led, very successfully in many ways, with Grit. So you're getting another form of MGA being formed that isn't really about actually underwriting expertise. It's not even about distribution. The brokers already have the distribution. What they want is efficiency. They want to say, once we've got a price from a competent insurer, why do we need to wander around the market with our slipcasing, seeing who's at lunch, who's not playing golf, and who's having a bad hair day? They don't. We just want to place it in the facility and get on it, and that's more efficient for our clients. The challenge there is we need the underwriting to stay. So it's all about distribution, but as Robert Hiscox used to say, when him and Cullen used to argue, no, it's not about distribution, it's all about underwriting. And that's where the MGAs cross that line. If we can be, as Olly said, flexible and think about distribution, how we get our product out there, when the capital balance businesses are clearly having to think about their main asset, which is their balance sheets, we can be better distributors. And I think that's key to why MGAs succeed. They think about their products, okay? They think about distribution, they have expertise in areas, and they can deliver it better than the carrier can. But they have to, at the same time, think about the underwriting results. And I think the point Olly made is a good one, that, you know, people, we always focus our business on people first. It's about how do we attract people. In the old days, when I started in Lloyds in 1982 and went through all the bad years and saw reconstruction renewal, and I was one of the brokers queuing at HS Weavers, knowing perfectly well there was a reason I had to queue 5 days to get a line from Roger Borley because he was cheaper than anyone else. But we all knew it, and when it came and hit, we went, oh God, what a surprise. It wasn't any surprise at all. And you'll know carriers out there today that were thinking, oh, that looks a bit racy in today's market. But the reality is, seeing all of those things come through, and we are today in an absolutely new market where we can take advantage. It's not a soft market cycle, it is where we are today in the business. And I think the MGAs that survive are the one. It's not one answer. It's all those who think about the cost of capital. It's all those who think about how they attract the people. It's all those who think about what the distribution is. It's all those that think about, okay, are we going to go direct? I mean, most MGAs today get their business through brokers, okay? Most of the insurtech ones who are starting up aren't interested in the brokers. They are part of the 40% they want to get rid of. They're part of the margin, absolutely part of the margin they want to get rid of. The insurers have got to think about the cost of capital. So to me, those that will survive are those that think about all those things in one and can get it right. And I think they will thrive in the market. I think there's 3 other things I would leave you with. Is back to the Weaver story. I think the quality of an MGA is often defined by the quality of its capacity providers. And if that's the arts and craft of El Paso, you've probably got, which is one of Weaver's as well, you've probably got some there. So I think that, and we've had the privilege since the really mid-90s to have some insurers like Arch backing us throughout that time. They knew we weren't for sale. We knew we were going to be partners to them through thick or thin. They're a quality partner of us, and we can do that now. We can talk about the quality of our capacity providers. They can give us credibility. And that's quite important when you're looking at brokers and whether they want to give you actually premium, because they are going to think about what is the quality of that MGA. If we've got loads growing up, where you are on that broker security list is pretty important, I can tell you. And the quality of your capacity providers will detect very often how the broker views it. Second thing is, what do you want to achieve? What, you know, are you just building to sell it? In which case, that's a different business model. Let's talk about it, private equity. Or do you want to build something that really is going to grow and have long-term value? And then you really got to think about, what's my strategy for that in a very, very, very fast changing market? And the final point I would leave is that, and I think it's fundamental, is that we've talked about it a bit. The new generation coming through, the problem with this market is within 6 years, 60% of the people in insurance are due to retire. And it's phenomenal figures. We are a massively aging market. We're not well perceived generally. We've got to go out there and sell to the new world. We've got to get the young blood into our business and find us an attractive industry to work, an industry that can actually sell to the new generation who can be the buyers. Because we're still selling to the old generation. They're predominantly the people buying insurance. We need to work out how are we going to sell, whether MGA, broker, insurer, the new generation doing through. And you won't let that happen unless you've got the people who are actually affiliated with that lot on it. So that's my 5 minutes, probably a bit more. And I'm happy we'll do questions later on.
Let's take questions. Thank you very much, David. Yes, as we're part of the massively aging generation, may I hand over to somebody much younger. Karen, perhaps give us your take on, how one drives the business forward successfully as UK General has done.
So my name is Karen Beales, UK General CEO. I've been with the business now for just over 15 years, and interestingly, we have been through a whole evolution of our business, and absolutely through the diagrams as Olly has shown. So we were actually originally the third-party schemes section of UK insurance. So we were originally an insurer. We used capacity from UK insurance. We were sold to a private individual essentially in 2002, and have been part of that group of companies for 15 years. About 18 months ago, the individual had approached us from the market, and we went through a sale process. We're now 6 weeks into our new owners, JC Flowers, obviously private equity, so we are in that 25% as Olly said. And interestingly, obviously a question that we asked of Flowers when we were going through all those tortuous management presentations was actually, why do you want to buy us? We wanted to ask them what they thought about us and why they were attracted to us as a business. And they've very much said it is exactly as Olly said about that organic growth. It's about growing the business. It's about continuing to do more of what we currently do, but having that investment behind us to enable us to do it. And we think it's a really exciting time. I appreciate it's honeymoon period and we need to deliver plans and all that, and private equity isn't easy. But equally, we really think that, we've got a great opportunity ahead of us to really grow the business, but with an absolute clear direction. That's previously within a family-owned type business. That wasn't there. That's not how that was operated. That's not how that worked. But some real clarity for individuals within the business and the business itself. And to the point that was made earlier about attracting people, about attracting great people into the business, that absolutely is key, to continually keep growing, to keep changing and to keep evolving, exactly as we're talking about today. The one thing that remains constant is, if you don't change, if you don't move, you will go backwards. You won't stay the same. That absolutely is key for me. And for us, we are probably very diverse. To David's business, we are personal lines only. We are very niche products, and that is really where I think an MGA adds value in the distribution chain. I do think distribution is key. I do think capacity is absolutely utmost. It's so important to work closely with your capacity providers to make sure that you're delivering what they need, and you equally agree between you their expectations of you and you of them. I think that is absolutely key to have that clarity. And equally, to make sure that you have that technology behind you, that you do keep moving forwards, that you do keep thinking about doing niche, different, something that the composite market can't do, that the larger players, and that is really where we have our position in the market. That's my view of MGAs. I think we are here to stay. I think we will continue to grow. I think it's a great time for us, and I really genuinely believe that we have got a really great position in the market at the moment. Thank you.
Karen, thank you very much. And over to Jason for your take on.
Thank you. So my name's Jason Anthony, and 18 months ago I made the brave decision to start up a new MGA. I believe that there was a lot of change coming in the market, and that the cost of technology to MGAs and to distribution isn't necessarily appreciated by the insurers when they say, will you do this smaller change on your board row? The effect that has on us as a business can be very expensive. So I wanted to set up an MGA whereby we provided assistance to, I've quite often called it the Victorian pipework distribution. I believe that the industry is ripe for change. I think there will be a Kodak moment. Some of the big players will change. It's not in their interest, though, for the distribution model to change at the moment. They're very happy with the business sitting in the distribution that it is. And it's up for us to challenge that. I purposefully went and sat out in Shoreditch, and I turned up for the first day in the office in a suit, and was standing next to a gentleman in denim dungarees. So I grew a beard and decided to get down with the kids. And it's fascinating, actually. It's fascinating how they perceive insurance. It's fascinating what they're trying to do to change. There's a gap, though, in that we're a heavily regulated industry, and there's they want to sell the policy to the client, and they want it to be in a very easy fashion. I think that what I was trying to do was to help facilitate that. What we tried to do is help facilitate that in having a conversation with the insurer, because that's sometimes where you find that sort of what I think the millennials who are seeking change. That's where they that's where they might struggle a bit. So I know the conversation about the Ints Tech, or is it Tech Ints? I don't know. It's this afternoon, but I think that it's right. That's part of the evolution of the MGA. If we all use Google, if we don't get the answer that we want out of on Google in less than 2 seconds, 50% of us turn it off. My background is high volume, low premium business. Low premium not because I charge lower rates, purely because the technical premium's lower. there are 4.2 million businesses in the UK who don't employ anybody, and that's target market. So there's a huge market out there. It's right for how we change how we approach those people, how we conduct ourselves with them, how we get the product to them. It's interesting what what people are saying about the cost. So if an MGA provides work transfer, and if the cost allocation is representative of that work transfer, we are not an additional cost in the chain. I will not accept, sitting in front of an insurer who says that we're a cost to distribution. I believe that we're there to provide an underwriting profit. We're there to provide services to the underwriter in terms of compliance, conduct risk, wording, and issuing of the policy. And that it's right that when we started Oxygen in 2005, that's when capacity was getting very intellectual, and the people were buying less reinsurance, so the reinsurers were being squeezed. So we were approached by our leading reinsurer to say, look, we'd actually like to underwrite your business from the ground up, and that made it a perfect partnership in terms of for an MGA. So we set up Oxygen Insurance Managers. Many of you know that went on to become OIM within Gallagher, and then that obviously trades forward today as Penn. I just felt that there's a lot of room for change. There was a lot of happening. I think there's a lot of independent brokers and MGAs out there, and I liked the idea of the independence. I like the idea of adding value to the independent MGAs in order that we can say, look, there's a cost to the IT. We can help you with that if you come, within the MGAM family. It's a partnership, and it very much is a portfolio underwriting approach. So I think that sort of sums up where I come from. It's at the moment it's very bespoke distribution. It's UK SME. I think that there's a lot happening in that area. I went out and raised private money to do it, and I didn't want to go into areas of insurance and distribution that I wasn't familiar with in the first instance with the shareholders' funds, because otherwise I'd lose all my friends in the city. So, thank you.
Thank you, Jason. I'm now going to throw it open to questions. I'm actually going to ask the panelists whether any of you want to put questions to your fellow panelists before we hear from the floor. Anything controversial? Well, I'll give you that opportunity again later. Ladies and gentlemen, over to you. Who would like to pose the first question to any of our panelists? And you can choose to put something to an individual or generally. Reg.
Well, a very simple question for Olly, if I may. 190 MGAs, you said. How accurate is that figure, and where did you get it from? Because when we started, we had no idea, and we put the number out the air.
Okay, that's a very good question. I mean, there's not too much of a plug. We've mapped the entire financial services industry. We take the FCA register, we map into Companies House, and then go through each business which is authorised and say we think it's this. Now, we may get it wrong occasionally, but that doesn't really matter. What matters is the change of direction. I should also say that picks up the principal activity. There may be companies that have, we would deem to mainly a commercial broker which had a significant MGA beneath it. So that's how we did it. We did it manually. We did it from the complete list of every authorised entity in the UK. But the key message is the direction. And that clearly is going, I mean, if you look at the numbers, MGAs represent 3 times more of the industry in 2017 than they did in 2005. And that's a fundamental change.
Thank you very much. Something else? Let me use the chairman's prerogatives to try and kick things off. David, you spoke about importance of delivering value to the ultimate client, the policyholder, and obviously insurers and MGAs are on side in doing that. But also, speaking now from the capacity provider standpoint, we look for MGAs to provide value to us. Now, why should we use MGAs as outsourced underwriters rather than employing our own underwriters and waiting for the brokers to come to see us or going out to see the brokers. What is the difference? What is the MGA add in the value chain to the insurer as well as the policyholder? Any of you, but I'm going to start with you, David, because you threw down that challenge.
Well, I don't think I'd deviate from my original D. So I think the insurer is looking for distribution. That includes technical distribution. As I did say, they want underwriting results. They're not just looking for, so they're only going to do it if they feel that the MGA can access, and I think you made a good point about niche products tend to be niche, not composite products. They can access other markets that they wouldn't be able to access, or back to Jason's point, wouldn't be able to access as cost effectively. So I think Lloyd's is a very good example of that. I mean, a huge percentage of Lloyd's premium, I think it's something touching like 40% of it, actually comes from the binder model. I mean, it's a massive proportion. We own a business called Bowoods, and all Bowoods does is put US and international binder premium into Lloyd's, and we put over $1 billion. So it's about markets that somehow, for a reason, whatever they may be, want to access distribution they can't get themselves or can get more cheaply, and that has to be a combination of all the things I talked about. Yes, technical, so it's got to be underwriting discipline, but it's got to be expertise, etc. And I think the question I'd almost turn around perhaps to the insurers is if this trend continues, because the other trend we've seen, one is the rise of the MGAs, the other is the rise of the in-house broker facilities. So those two things are putting significant squeeze, I'd say, on significant pools of premium. Not so much maybe amongst some of the smaller independent pieces, but on the bigger risks of business. So, and then you've got in that mix, you've got intelligent capital, certainly capital that's learning very fast about the insurance market. And you're already seeing some syndicates, many years now, looking at how they can provide much cheaper capital. And the question really comes is, why do insurers need underwriters? Rather than why do they need MGAs? I mean, to me, that is going to be a large part of the market. And there are some very significant Lloyd's syndicates that are looking at really having a two-tier process in that. We'll have this capital base here that's designed to provide capital to trust it, but nevertheless, third-party underwriting everything else. And we will have, because they've got to have low cost. And it's very difficult in some places to have low cost.
If I could come in there, I'm thinking that's what I was talking about, that the functions of the insurers will become increasingly narrow to around just managing their capital. And clearly with the regulatory regime, with the PRA, you absolutely need that function. That won't disappear. And that will be regulated. But I do see long-term pressure. And I think that you will see companies, insurance companies resisting this and looking to buy businesses, but the long-term pressure to specialise in just one function and outsource. And the problem about outsourcing is large companies often don't understand their own cost structures, and therefore when they say, oh, we can do claims cheaper than you can as a specialist outsourced service, as often isn't the case. But the people in the organisation don't want to admit that, and the business is so complex, it's very hard to actually produce a cost per claim, which is what you're pitching against.
And I think it does link on this point that the insurers, particularly at certain levels, understand the need to reduce that cost of capital, that they get that. And it is very much working together, and that's why my earlier point about the quality of an MGA can, I think, be defined by its quality of its capacity provider. Now, that doesn't have to be a traditional insurer, of course. There can be other different types of capital providers. But I think if you want credibility in the MGA, you've got to have this alignment. You've got to have a long term. You've got to look at either the broker or the individual if they're buying direct and say, we're going to be here to deliver this service. But I think there's a seismic shift going on. If we don't do it, the old boys in the market don't do it. The new ones coming along have definitely seen this, and technology plays a big part, because we again know most insurers struggle because of legacy systems to really get up to speed with the new technologies. I think it's an inevitable. It's just a question of how long.
Yeah, I agree. I think from the point of an insurer, obviously, they have legacy systems. They're established to sell to mass market, and just back to the point on niche, that's where I genuinely think that MGAs have a great opportunity to do something slightly different, to tailor the products to the end consumer, to give the value to the customers we were talking about, but then in turn becomes more difficult for the insurer to actually write those products, because do the underwriters actually have the expertise to write those individual niche areas of business? If they're writing mass market, that a lot of it is probably from data analytics. They're probably getting their information. And actually, the expertise, to your point, around do you actually need underwriters in insurer is probably quite a good one for some of the niche products. Why have them? Huge computers, all the information now that insurers are using to deliver pricing. Actually, the expertise could sit within an MGA to individually write those risks. I genuinely feel that's an opportunity for us.
I'd also add that technology is creating ever more niches. I mean, I remember seeing in someone's office a rather splendid pricing sheet and all it had was the price of the car. Something until 1920 this was the price of the car and the insurance rate. So there was no niche market in insurance. There was just how much you pay for the car, that was the cost of insurance. So we're seeing ever increasing niches coming through, and that creates the opportunity for specialization. I think the other huge revolution which is going to come through is that historically insurance has been dominated by manufacturers. It's hard to manufacture, and therefore it's all built around the manufacturing of the product. In 10, 15 years' time, it'll all be based around the individual. The individual will have a profile based on his LinkedIn, his Airbnb, all sorts of different factors, and he will buy a portfolio of different products which he will flex. But it won't be him buying 10 different products or 20 different products. It'll be him at the centre of which he just buys a bit more, a bit less in terms of his life circumstance. But the whole industry has been based around the manufacturing as opposed to the customer, and that is now changing.
And can I just pick on that, because I think it's a fascinating point. When I set up Jewel, one of the key figures we tracked was how much of his business was new. And the answer was, early days, Jewel, 60% of its new business was new. So we weren't churning, we were actually creating markets. And we all know that actually most of today's world isn't insured. And if we focus as MGAs on trying to work out how to bring a new premium and sell new ways, I think that's a huge opportunity.
I think that I think you guys are the traditional market makers of the industry. You're solutions based, you're entrepreneurial, you're competitive. There are a lot of carriers who struggle to make a decision. If you don't find a solution, you're not going to get paid. Whereas carriers, traditionally, if they say no, they're still going to get paid at the end of the month. And I think that drives a lot of the way that we look to provide answers to the clients. It's interesting what people say about do you need an underwriter? I've seen the technology. In less than 12 months, people will be able to buy an insurance, their insurance, be it house or be it their SME insurance, through an AI. You won't be talking to someone on the end of the phone. You'll be logging onto a computer and you will be talking to an AI, and they will be able to provide you with a quote. It is coming, and I think that's the evolution of the MGA is to it can't be that it takes 60 days to get the information to the carrier that he's on risk for a client. It's got to be instantaneous. Solvency II, everything's driving. And MGAs are able to. We've been able to invest in new technology, and I think that that means that we haven't got the legacy. And I think that insurers are going to struggle, and that's what will bring the change, and that's why MGAs will continue to thrive. I think that interestingly, one of the reasons why that we see the broker curve, and I think that the insurer curve would be the same, is they're all smashing themselves together to get economies of scale. We're all driving, we're all running, pretty, SME businesses. So, we have to look at our P&L, we have to look at our cash flow, and manage our businesses accordingly. I think we're going to see more consolidation from insurers, which, I think that's just an inevitability of the fact that they're too expensive, and what we can do is provide a solution, and it's got to be cost effective.
I think insurers do typically provide products as well. They assume that we collectively all want to buy the same thing, and that certainly is not the case, exactly as you're saying. As we've said, the products themselves will be designed by the end consumer. They will choose and select the elements of cover that they want. There are very, very few younger people now who buy home contents in the same way that I would do. They want cover for maybe their pedal cycle gadgets, things like that. From a personal point of view, they don't want a home buildings and contents cover. And all of that change is coming along, and we're in a great place to provide that, whereas the insurers still just provide buildings or contents or both. And that really is the level of flexibility that they have.
We've had some fairly thought-provoking comments from the panel. Surely there must be a few questions out there about our challenges. Yes.
Talk about quality MGAs, but I'd like to understand from the panel what makes a quality capacity provider. You talk about choosing your capacity provider carefully. What are the factors that would make a good quality capacity provider?
Just in case people didn't at the back of the room didn't hear that because the microphone arrived a little late. The question was, what makes a good quality capacity provider? What are MGAs looking for in the insurers?
One who provides a good profit commission. No, so it's a partnership, and you enter into the partnership, and it goes back to what I was saying earlier about work transfer. So the insurer has got to understand what the MGA can do and make sure that they do it to a quality that's required for compliance and regulation. And then they need to let the MGA to get on it. They've got to empower the MGA because a quality MGA will then go out and get distribution for them. If you're tripping over your carrier all the time in who's doing what, then that can create friction. I think that MGAs need to own up and own their loss ratios. I think they need to employ their actuarial services, either direct or indirect. For too long, a lot of MGAs, have said they're acting on behalf of the carrier, but sometimes the behaviour is a click on the ticket of the distribution. I think we need to put our hands up and say we act for the carrier. We're innovative. We're looking at bringing product and that partnership then. You're working in tandem. We're no different. You've got carrier with a capacity, and they've got direct underwriters, and they're paying, brokers or Google broker to access that distribution, and we're another source of distribution. There shouldn't be additional costs coming on us, and we're providing them with the same services as their own underwriting teams.
Can I just add to that same thing? I think there is something very much I talked about earlier, that the quality of the MGA is divided by the quality of its capacity provider. And I think that, particularly if you're looking to, it's different on personal lines, because on personal lines, if people are happy to buy insurance from a nodding dog or a meerkat, maybe they don't really care about it. I'm being serious in a way, so much the carrier. As you move up the business scale, then I think businesses are interested about who is the capacity behind the MGA. So it's just like if I was a distributor, I might rather distribute, BMW or Mercedes if I want a certain type of market share. So I think when you move on the MGA scale, the quality of that insurer does it. And that, of course, includes everything from, to be blunt, their rating, what is their S&P best rating, through to most importantly, what's their claims paying like. Because at the end of the day, if this is a product for a client, ultimately the client wants his getting paid. The claim service is fundamental to our industry. We often forget it. We often put it at the back, because it really should be at the front. What they want to buy and make, what they experience want to be. So to me, it's that. And then if you get that alignment, it's got to be also about this is long term. And I've touched upon the point that we've had relationships with some insurers for it's 15, 20 years, because we all know where we're going. We're not going to flog. They're not going to find us tomorrow flogging their business, so that suddenly they're being removed from capacity and given to whoever. And I think that a long-term alignment, because you can't come in, particularly if you're trying to create new markets, you can't come in and out of markets. You come in and out of markets, you're dead in the water.
I agree partly, but actually from a personal lines perspective, whilst the end consumer might not mind if they're buying from a meerkat, I do think if you are building an MGA and you're looking to sell in time, having capacity that is A-rated that sits behind you speaks volumes. It shows actually that they've obviously completed significant due diligence. They are meeting with you regularly. To your point, the very close partnership that you're working together actually helps that end sale.
I'm talking about sale and private equity, of course. Private equity, although they'll tell you otherwise, are actually quite inexpert. And one of the things they look at is other measures of quality, and clearly having a quality provider is one of those.
Interestingly, one of the questions we had from one of the PE was, can you remind me again what IPT is?
Yeah.
That's one of the questions we had on one of the presentations. So that's
10% and going up is the answer. Because we're a soft target. Just from an insurer point of view, I think clearly rating, reputation, and above all, speed, efficiency, and pleasantness in settling the claims. I think that's what the consumer is looking for. Can I just ask a sort of follow-up to that? If you're not buying your insurance from from a bulldog or a meerkat or whatever. How important, from an MGA standpoint, is the branding of the insurer? Does it make any difference at all? Whose branding counts?
I think that it's important that the rating is important in terms of A rating. But then after that, I think that it's important that I say it's important. I personally, because of the way we work in the wholesale market, I think the branding's important in terms of how we present to you and the rest of the market. But in terms of the client, I think that it's a lot of personal lines and the SME market, their broker, MGA. That's the branding that's important. That's the person they're buying their product from. That's where they want their point of service. That's where they want their claim paid. That's where they want to hold their hand. That's who they want to. I was chatting to someone the other day about why is it that more business at the moment isn't migrating over onto platforms, and it's because that particular industry that I was chatting about, they still wanted somebody to make the decision to help them acquire the policy, and that's so therefore that brand is terribly important.
And I do think, again, it's back to what the MGA is doing. So if your MGA is predominantly focused at quite larger professional brokers, they will care about the branding, and so will the ultimate client. That so we have got a big MGA in Germany, and we write a lot of business, and we've got carriers behind us like there, Alliance, part of that, and then the markets there with your very seasoned market. In the US, we talk about the US, which is the world's biggest MGA market by miles, so we should at least touch upon it. There, absolutely. Munich Re are one of our big capacity providers. The first thing when I actually acquired that business, sat down with the CEO of Justin, we looked at his business, the very first question I said to him was, Justin, look at this, it's a great business, it's a 100 million business already, we want to take it to a 500 million business, the first thing you've got to do is replace your carriers. I looked at them and none of them went, they all went, they're the ones that may go, and we've slowly over time replaced us, and sure enough, the brokers have started to use us more. So I do think there is an element there that the brand helps.
I think it is important to the affinity brands as well. If you are selling through a brand, through another customer before you get to the end consumer, it is important to them as well. More and more they're interested in the insurer and obviously security for their customers as well.
Yes, another question from the audience. Hang on a bit for the microphone to come through. Thank you.
Yeah, Bernard Goyder from the Insurance Insider here. Just wanted to pick up on David's point about claims. Both Karen and Jason, I'd just be interested to know how you handle claims and who takes responsibility for it, whether it's yourselves or whether it's the capacity provider. And it goes back to an important point about who takes responsibility. There was a case in Lloyd's recently where the lead market had agreed to pay a claim, but an MGA that was further down on the slip refused to pay the claim for a year. Until eventually they were forced to, and I just wondered what can we do to make kind of using MGAs a better experience for insureds and for clients?
We're probably slightly different in that we have delegated authority to handle the claims, and we in turn outsource them to specialists of those niche products because we don't write mass market. So we actually outsource them to specialists, and then we oversee them, audit, and then larger claims or more complex or perhaps one that require referral to ombudsman and so on, actually come into a team in our office in Leeds. So we're probably slightly different. We're actually making the decision rather than the insurer. Our level of authority is relatively high in that respect. So it's more that we're making the decision to pay the claim. So I guess we're probably slightly different. So
I went for an outsourced model, and the reason why I did that is because people that we partner with, their IT was beyond anything that I'd seen in terms of how we can then use that data to manage our book. I think it is terribly important that so long as you're managing the conflicts of interest that can naturally arise if you're an MGA with underwriting and claims authority, I think it can be done. But I think also that's an important part of not only the customer journey, but if you're in the broker market, the broker journey too, because they're your client. And you want to make sure that you're keeping them informed from an underwriting perspective, but also that the claim is being looked after and that you're doing the best for the claim, first party or third party, in order that you get the best claims result so that it doesn't prejudice their future insurance acquisition purchasing.
I think that it also comes back to this alignment point, and you touched upon it earlier. I think The need now for MGAs to invest in data is enormous. I think if we don't invest in data, we will be dead in the water. And that isn't data just about, the ultimate customer base and what they want to buy and whether they want to buy a home disintegrated or whatever it may be, but it is about the claims data as well. So we absolutely, in Jewel invest very heavily in our actuarial service so that we can have meaningful conversations with our partners, with insurers. So look, this is the claims because this is where we are. And if we actually want to provide a good claims service, we provide it in an overall view of how our portfolio is performing rather than arguments on individual clients, because that's a non-alignment. Because if you start chucking out a claim in, and again I come back to the international scale, in Australia or Italy or Germany or Finland, you'll soon lose a reputation, absolutely very quickly indeed. And I think that holding on a joint reputation between us and the carrier is vital, and therefore you need alignment on what you're trying to do with that underwriting portfolio.
I mean, we would see claims very much as part of adding value because it adds information. Now, whether you outsource and access information, whether you do it yourself, but I think that's more and more what's happening is people are doing their own claims or taking responsibility for them, and it's very, very quick feedback. It's like if your market is changing, you find it in your claims. So we would see that as, when we look at a business, one of the factors we think, is this an MGA or is it a glorified broker, wholesale broker? It's around the claims management process.
I think as well, the point around data is really important. It's not just data from an actuarial perspective,
No.
It's also from a conduct point of view, so that you have that information to hand. You can see if there are any trends in the types of business you're writing, if there are any issues that you spot. And equally as well, it helps you to understand where the customers clearly are either claiming or not claiming. Loss ratios too high as well as too low. There are instances where we need to look at that nowadays. It's not just, it's making sure that customer has value for money. So, I, from my point of view, I think it's using the information from that perspective as well to help us to understand what our customers are buying, why they're buying them.
I'd just add to that I think there has to be, reciprocal exchange of data so that, if the carrier is handling the claim, you demand of them the same information as they're demanding of you, because it's your client, it's your business, and as Olly said, the IP in your business is in your underwriting result. And mustn't forget that. I know there are some insurers that won't give you the figures if you can't provide triangulated claims experience, development curves on your business. And how can you turn around to the carrier and say that we'll manage the portfolio? You'll just be dictated to, and that's not the true role of the MGA. The MGA, who's empowered, will tell the carrier where they're taking the book, and that's the evolution as such. That's a change. We're in a much stronger position nowadays because of the IT that's available to us.
Sorry, can I go to the back first, and then I'll come to you?
Hi, good morning. It's Mark Tyrrell from Bluefin.
Who'd like to start with that one? Jason.
So it wasn't delayed. So we act on behalf of the carrier. We're looking for an underwriting result. So I think that's very clear where we sit in the on which side we're not. When we go through when we're talking to a cover holder, we go through a conduct risk process. So we want to know at what point the client is advised. And at what point, the cover holder is binding on behalf of the insurer. So, I would say from my perspective, we're already managing that conflict of interest, because you can see it's coming, and you have to be clear in your communication. You have to be clear in the demonstration of the delegation of the process. Who's doing what in the chain, and you can. I think you can manage that conflict quite easily, and using again. I'm sounding a bit repetitive. We've built a system so that all of our compliance process is on an IT platform, and that's the way it's got to go. We've got to cut cost out of the compliance process. There are vast departments, and this is part of the problem for insurers, because they've got these huge costs, this huge cost base, and it's because these departments filled with their most expensive cost, and that's people. And I think that change is coming in order that the industry as a whole will improve itself, and that process will manage the cost, but it will also manage the conflict of interest.
Pick up on that point. I think that it leads into an interesting area because obviously transparency is fundamental. I think what was in the industry, what we need to be is transparent on cost. And I've talked a lot about cost today, so we're very focused on we have to somehow be efficient and be transparent on cost. I think it leads into the fact of where our business, we have really separate regulated businesses, where absolutely the duty of care of the MGA is to the insurer. Now that we are the agent of the insurer, now we need to be transparent on that and how we work with it. What's interesting is where it crosses over, like we have, is where you own, as a holding company, a broker and an MGA in the same arm. And that's much more prevalent. It's prevalent here, but it's certainly a big issue in the US, where most of the US wholesale brokers are now churning themselves into MGAs. And I think being very transparent and clear on that, and where your duty of care lies, and how independent the businesses are, is going to be fundamental going forward.
Come to the in front row. Thank you, sir.
Hello, I'm Jörg from Munich. My question is, I think in MGA, the amount of benefit an MGA brings to the table is pretty much different whether it's in more an underwriting-led model or more a distribution-led model. In parallel, we have the tendency that we deal with much more data, be it risk-related data or adjacent data, which comes into play whilst trying to generate an underwriting profit. How does that trend really influence the attractiveness of an MGA and its business model going forward?
Well, I would say, as an MGA, we need to continually be investing ourselves into data, making sure that we don't necessarily have to replicate, and clearly it's important we don't replicate exactly what the insurer is doing, because obviously that is essentially a waste of money. The point around works transfer, and you're right, it does depend on whether you're looking at the distribution or whether you're looking at the underwriting, but I think there is an opportunity to do both. I really do, and I genuinely feel that, again, I suppose back to, again, being repetitive, back to the point I was making, if you are looking at more niche or different types of distribution or different types of customers, that's where perhaps the insurer wouldn't necessarily have the data even, that they're probably in those smaller pockets of markets, there perhaps isn't that necessary information, and they can work with the MGA to build that and to build both companies' respective knowledge.
And I think that's fundamental because there isn't one MJ model, and anyone who's in knows that there isn't. And so the reality is you're going to have ones that are more distribution-led, where the data's got to be very good, very on time, absolutely know where it is, and that's really where you're going with that. And there's lots of people here with expertise that need to somehow work out how they now capture that with data. But then you've got the second model that is in essence more underwriter-led. If you look at the fund management services business, a few years ago, fund managers got about 1.5% from managing people's funds. Then someone came up with the idea of the tracker. And now average fund managers is a third of what they used to be. They've dropped from 1.5% to 0.5%. And the cheapest funds trackers charge 0.006%. As an insurance industry, we think about that. Martin Gilbert, who runs Aberdeen, said, it's very true, but you know what? The profit margin is of the fund managers since that massive drop. It's the same. Why is it the same? How have the fund managers managed to go from 1.5% to 0.5% at best and 0.006% at worst? Because they've used what's available now in data and technology to drive their business model. And we've got to embrace all that. Otherwise, we won't be the survivors.
I think that we all have data. We all know we've got data. That's the problem. It's how we drive the value and the information from that data, and what systems do we employ to drive that value and that information, and then use it intellectually in order that we can benefit the policyholder in terms of the solutions we're providing them, but also drive cost out of what is a very expensive model at the moment.
I think it's also worth bearing in mind that we talk about technology and it's going in this direction or that direction, but actually technology produces all sorts of surprises. And whilst MGAs can be very good at getting data on the Pacific market, what they may miss out is data on the whole market. And so maybe an insurer partner, one of its jobs will be to organise capital. The other job is to make sure that the very big data trends it's picking up and providing it to its partners to make sure that if there's a broader start-all change, that is picked up in pricing quicker than it could be done by the MGA by itself.
Right, can I chip in with another one then? Is there a minimum size, effective size for an MGA? How big do you need to be to survive, and can you get too big?
Ooh. I think that we took a lot. MGM took a lot of investment in order that we could build infrastructure and take our time in terms of the clients coming on. I know that there are a lot of people who believe that they have £2 to £3 million GWP and they've got an MGA. I think that that's probably a little bit optimistic. It will depend on the market. It will depend on the product you're putting out. At the end of the day, what you need, making that transfer from underwriter to MGA owner, it's a business leap because you're managing a P&L, you're managing cash flow, and any small. It doesn't matter what industry you're in. Any small business will survive on its cash flow, and I think as an industry we would all know that because generally speaking, we're pretty independent. So, is there a minimum size? Well, absolutely, there has to be a minimum size, but it's really down to effectively, your individual model, your economy, your business, where you're adding value. It's interesting. I used to run when I was running a large MGA for a large broker. There was a metric in terms of what your salary costs were against revenue, and as a small MGA, I'm way below that number because we're trying to do as much through a computer platform as possible. So computers will allow us to continue and be small, niche, independent. But there is a critical number at which point you've got to pay the bills at the end of the day.
I think from a people perspective, as an MGA, if you want to differentiate yourself from a broker, from a wholesaler, it's having that expertise from an MI perspective, from an actuarial and pricing perspective. So you have to have sufficient volume to enable you to do so. And then clearly from an underwriting profitability point of view, the smaller the book, the more volatile as well. So obviously working with your insurer partner is equally more difficult if you have a smaller book of business to deliver that profit, in the event of one larger loss.
Yeah, I think it depends on the ambition of the business, because ultimately, if you're happy to have an owner-managed business, you need to think about what your sales strategy is and when you kind of what size that would be. But if you want to build something that's really going to be of interest, then of course you have to have ambition to do that. And then you need all the things that go with that. You need to get the attention of the carriers. You need to probably have a big enough book that actually you have got some flexibility on. You can have to buy reinsurance behind it, etc. So what we look at in Jules, we don't feel of ourselves as a big business. We're very much small business culture. Although we write about 750 million in premium, we think we're a very small business culture, but we've got big ambitions. And I think that's it. And to have those, you've got to have certain things in place. We've talked about regulation. We've talked about carrier capacity. We've talked about brokers. If you're getting on the security list of these brokers, you're not going to do it. They're all churning through at the moment. They're top 50. So there isn't an ultimate size, but there is if you've got ambition. Yes, there is.
That's an interesting discussion about size, because people come talk about size. Are we big enough? How large you have to be, etc., etc., and that can drive the decision to sell. What I would say generally is the costs of the benefits of scale are dramatically overstated, and that's because the costs of scale are complex and not immediately obvious. But very few large companies have lower costs than small companies. The reason why large companies are successful and buy small companies isn't because they're better, it's because they've got a much lower cost of capital. And we've been talking to a broker with income of about 50 million brokerage income, so a decent-sized broker. And he was utterly flabbergasted at the attitude of the banks towards lending him money without a private equity backer being there. So he's been forced to think about selling his business, not because bigger brokers are better, but because they can access capital which he can't.
Peter, you're signalling you've got a question?
Good afternoon. I'm Ron Ahmed, Lloyds. I was just wondering, alternative capital, is it just a feature of our economic times at the moment, or a longer-term significant opportunity or threat?
By alternative capital, do you mean not insurance capital at all?
Yes. Not insurance capital, other capital coming in to provide capacity.
Sounds like one for you, Olly.
Well, when I talked about it, I thought that the insurance cycle was dead. I think capital now is so flexible that as soon as there's a shortage of capital in this market, it will flow in from alternative capital. There are all sorts of ways getting into the market. So I think the key thing is that going forward, we should not expect to see the insurance cycle producing periods of superior profit. I think you're going to be, taking to David's point, there is a constant pressure on costs. And if you have a mature industry, which most industries are mature, the key factor is that constant remorseless pressure on costs. And that's cost of operating and it's cost of capital. And that is not going to go away.
And I think, we shouldn't see it as a threat. It's an absolute opportunity for our industry, because if it does bring a lower cost of capital, which is one of the big costs of the business, and I always talked about it in the form of M&As, etc., then that's got to be our benefit for industry. And what I think you're seeing is there's a shift from people who think it's going to come in and just sit by itself. It's not. This capital has to link up in some way with expertise. It has to link up with people who can manage the capital, can do it. The question will be, who's the best people to manage that capital, and how does it access the market? So we should embrace it, but decide how we want to invite it in.
Should we go for incremental improvement on a business model which isn't working, or should we look to do something different? And as an industry, as an MGA, I think we should look to do something different, because I think we've all got a fantastic opportunity, and we can all do it better.
And I just think by having the expertise that we have, we will enable that other capacity to facilitate that into the market. It may be easier.
Can I ask a supplementary following that one? What's the regulator going to say about all of this?
So
again, it's the same problem. It's like I was saying earlier with these millennials. They're coming up with some great ideas, but what we're a regulated industry, and that's why I don't think that there's not going to be an Uber moment in insurance. What it's going to be is that it'll be gradual change as these people understand compliance and regulation. And again, as we face the insurer capital, as new capital comes in, they've got to understand that we're a regulated industry. There are practices that we have to adhere to and sign up to and answer to the regulator. So as long as they're coming in on that basis, then there's definitely a role. I spent some time in the hedge fund market whilst I was tending the garden. And what was interesting to me is when you sit with a hedge fund, they absolutely know their client inside out, both ways. And as an industry, I'm not sure that we necessarily do that so well, because you need to understand from your insuring partner what they want, what are they looking for in the relationship, and if there's a conflict in that relationship, are they the right partner? Well, new capital coming in, they're here to learn, they're here to provide us with support, and I think that they can add value.
Hi, Chris Clacy from Abbey Legal here. Just sort of pinpointing your points on an industry where technological evolution is so important. Ironically, do you think that people within organisations now are more important than ever? And do you think that appointments in the future are going to be more technical-led or sales and distribution-led?
I mean, we've always built a business around people, because I think if you don't have the right people, you're not going to get the right solutions. And I think, as all the panels touched upon, if we really want to sell to the next generation, find the next products, do all of that, they've got to be people who are slightly different than all the same people. You get all the same people in the room, it's not a good thing. So I think we've got to attract that talent into the industry and give it the opportunity to come up with these ideas. Lots of the MGAs we've backed have been by really, and that's, I think, the point, is that MGA is a great place for people with great ideas to do startups. It's very difficult to do them in heavily capital managed businesses and in big organisations that tend to eat their children. So whenever we set up MGAs, we are putting them out so they can actually flourish. And to do that, you need, not necessarily younger, but just people with different ideas and different views who can have a go and are not afraid to fail. You talk about hedge funds and fund managers and private equity. What's the one thing about all those businesses? They don't mind failure. Failure is a success. In our industry, too often, failure is not a success. We need to embrace it until we get it right. And actually, there are no Uber moments. Uber wasn't actually created like that overnight. We've had private equity backing us for a while. Most of these technology revolutions weren't revolutions; they were evolutions, and we need to do the same in insurance.
And I think there still will be sales and distribution, just a different type of sales and distribution. We will need technology, we will need that expertise in our businesses, but we still know that our customers, we still know those people that we're dealing with, and it might just be about distributing in slightly different ways.
I think that you know, it's horses for courses. I had a friend who recently had a difficult theft claim, and so I didn't reach out to a computer. I actually reached out to an MGA who's here today, and they've did a very good job in managing that client, helping that client, and providing a solution. We wouldn't have been able to help her through an AI, through an underwriting platform, an IT underwriting platform. So I just think that life comes down to the 80-20 rule, doesn't it? There is going to be change. Certain businesses that we currently deal today with on a very personal basis will switch models and become a much more IT-based placement. But there will always be demand for people. And again, when it comes to the technical aspect, unless you have technical people who understand what the data that is coming out is telling you, then the data's valueless. So there will always be a place for people in the industry, but I think that there will be changes in how we deploy those people.
Yes, I think they're sort of all nice, kind words, but there is a difficult reality that we're facing, and that is that insurance is about information that's driven by technology. So there's going to be a dramatic opportunity to roll out artificial intelligence in all sorts of aspects of the industry. So it may mean that in 20 years' time we possibly employ a third less, or maybe employ 2/3 less people than we do today. So if you're dramatically shrinking your workforce, the challenge is how do you bring in new people when you've got too many old people in there already? And I think that is a real challenge which is going to face the industry. And I look around this room, as I look around almost every other insurance entity, it is staggering how many, I think it's male, pale and stale, which I include myself, are in the room. It's staggering how few coloured people or black people are in the room, and we are getting more women now. But as an industry, we lag incredibly behind. And if we are going to be shrinking the numbers dramatically, that is going to be an increasing challenge, not a decreasing one.
I'll just say from my point of view, in answer to that, people matter, and it doesn't really matter about age, gender, or anything else. At the end of the day, there is only one way to deal with a customer who has a particularly difficult claim, and that is to put a human being on the other end of a telephone, or to go and visit them and sort it out. It's amazing how much further you get than having some sort of artificial intelligence tell them what to do next. Particularly if you're dealing obviously in the retail market, even the commercial market, it ultimately makes a difference. I don't think people are going to disappear altogether, but I'd be very interested to see how AI copes.
I think that what could be, so my experience is that when an underwriter's been unemployed for 3 months, their salary aims they change. So I think that what could be interesting is that the cost of employing people could change as a result of the IT that's helping our businesses.
Do you think that's right for the millennials coming in now? Do you think they really do want to talk to somebody on the end of the phone? I'm clearly not of that age, so I have no idea. But I'm just thinking, sort of 18-year-olds now, do they really, really want to talk to someone to sort out their claim for their iPad or pedal cycle? Would they rather just do that online? I absolutely have no idea, even if it's difficult. I don't know. Yeah. And I think that's where we need to be thinking differently, rather than thinking as we do of our age.
To be perfectly honest, Karen, I don't know the answer to your question. It might well be that your hypothetical millennial with a fairly straightforward claim is going to be quite happy to deal with it online. Perhaps I tend to deal with policyholders who are sort of more of my generation, and
that's what I mean. I think we need to be thinking about that. We really need to be thinking differently. Yeah.
I mean, because I did this talk I did there, 18-year-olds. Was talking about what they thought about insurance. As 18-year-old students, what they thought about insurance, what they wanted to do, and it was fascinating. A lot of them talked about lemonade. So I know now about insurance. They talked about lemonade because that obviously caught their attention. A lot of them talked about, did we have a product for protecting their personal space on the internet and what have they. A lot of them got their own internet pages and whatever, and they wanted to know if they were selling stuff through it. So they were talking about all sorts of different insurances than what we would talk about. most of them weren't driving yet. They didn't think cars were useful at all. They didn't want to drive cars. They thought they were polluting. They had a completely different concept. So I'm fearful that we go on our own basis of what we think the next lot are going to want. I think the other point, Ollie, is a very good point, is that forget even as ultimately a claim service, AI is very, very effective at getting rid of monotonous, boring processes that are happening in place, and that is going to change the cost base of our industry, and it's going to mean that we need to have people do things and move people around. One of the advantages of having international business, we move people around countries, so we've got 40 countries, so we move people to places, move them around, because I think there is going to be a change to what's needed, particularly in certain big centres and in London and stuff like that. You're going to see quite a seismic shift in how many people are needed.
I'll just say we've only got another 5 minutes of the session, so if you've been sort of hiding your light under a bushel and determined to ask a question, this is your opportunity. I'm going to, if nobody else is going to, I'm going to give Mr. Brown another opportunity. Can somebody bring the Jane microphone, please? Thank you very much.
I was sitting here reminiscing about 1961-62 when I was filling in these forms to put all our records onto computers. And I thought to myself, in the future, there won't be people like me. The computer will do it all. So I've either got to be a thinker who tells the computer what to do, or a techie. And no way could I screw a screw up, let alone, be a techie. So it encouraged me to take the Chartered Insurance Institute exams because I wanted to be a thinker. And because I thought we wouldn't be employing all those people. What's happened? We've continued to employ, and we now employ far more than we ever did before. So I don't think we're going to see this great shrinkage of people employed in the business that is being suggested. Too late for me now anyway.
Which may actually sort of bring me to kind of what could be the last question of the session. As we talk about founding of MGAs, the growth of MGAs development. Let's think about the end game, because evolution means changing and moving on, possibly. Could I ask the panel, each of you for a couple of minutes, what do you think is the biggest single threat, if you like, or couple if you have more than one? What's the biggest single threat to the continued success of MGAs and the MGA industry? Who'd like to start with that?
I'll go first.
Karen?
Yeah. So I think for me there are two things. I think the capacity, making sure that you're working closely with your capacity provider, making sure that you do have that good relationship, and back to what we said right at the very beginning, the alignment of interest. I think that's the first thing for me. I think that's a risk that if you don't manage that relationship well, no capacity, you can't write in a business. And then secondly, regulation. I do think that the FCA, we're regulated just solely by the FCA, and I do think at the moment there is still not a full understanding of the MGA position in the distribution chain, and I think they're understanding that better. But I still think there could be some little hiccups and hurdles along the way there, and it's around understanding who's responsible for the different activities within the distribution chain. To your point around the work transfer, it's making sure that's very clear, and making sure that we as an organisation, if we are delegating authority in turn from the insurer to ourselves and then further down the chain, it's making sure that we have really clear oversight of that, because otherwise we could be caught out.
Well, I was going to talk about the life cycle, because I think the MGAs are successful. I've got no concern about that. But I think a huge concern with regulation is not actually existing businesses, but starting up new businesses. And we are great fans of regulation, because regulation increases barriers to entry. And if you have high barriers to entry, it increases capital value. It's not very good for the market or for the customers, but for the seller, it's fantastic. So we love lots of regulation, lots of barriers to entry. However, for an industry, it is very bad news if you cannot start up with fresh blood. And clearly, it can be done. But I think over the years, you have seen a continuing trend to make it harder to start new businesses. And I think that is a sartorial trend. I think it's a very dangerous trend, but that is what I think is the threat to the MGA market as a vibrant, separate market, is you won't be able to start up your own MGA in the future.
I think the main thing I would say is delineation. Where I told it before, we've talked about it, consolidation, what's going on. I think that the world is going to change at a very fast pace. and I think the MGAs have a huge role to play in that. But as people package more and more up, whether it's companies, doesn't matter capacity, doesn't matter what it is, the MGA's got to work out why is it still relevant. You know, is it going to be the one eating the lunch, or is someone else going to be eating the MGA's lunch? And you know, if you're not thinking about that, I can assure you, your competitors, your suppliers, your insurers even, who smile at you with one hand and the other would quite like to slit the knife in the back of you, are doing it. Yeah, you've got the pressure of the brokers, you've got the pressure of the insurers, you've got new capital now. Think about that. Who's going to be the winner in that field? And then wrapped around all that is what we've talked about. Is, you know, if data is king, and I think if you're ambitious and you want investors or grow the business, data is going to be king, because without it, however much knowledge you've got in your head, you haven't got that competitive advantage. I think investing in that and making sure you're still ahead of that, and you don't get Uberized, you don't get Pac-Maned up when you can run Uber, I think you've got to think about how you really manage that business in that way.
So one of my favourite sayings is by Winston Churchill, who said, after he lost his seat, he said, "What's the use of a WC without a seat? And what's the use of an MGA without its carrier?" Ultimately, so you absolutely agree. You know, you need that partnership. You need a very good relationship, and then complacency. Back to what Reg was saying, that, you know, people have been talking about the demise of the retail broker for numbers of years. They're still there. They're still hanging on, and they still do a terrific job for their client base. But what we can do is, as an industry, is to take the improvements that we see, and we can, so for, to take the compliance process, stick it on in a computer system, and the person who's doing the compliance today can sit in that broker's office doing a sale tomorrow, and then you can talk to more clients, and that's how I think we'll see change in the industry. I think if we harness the improvements that are coming, the processes that are coming, we get economies of scale, and we'll have a much improved business model.
Thank you. And that's brought us almost exactly to 12:30. So, ladies and gentlemen, I think we'll now let you get out and have your lunch break. We will obviously be around for the rest of the day, and if you want to continue the dialogue informally with any of us, please search us out. But in the meantime, please would you join me in thanking our panelists for their time in the usual way.